Hello and welcome to another episode of Darwin Investors. So yeah, the stock market, we all know how to play it. It's very, very, very easy. All you do is take the companies that you know and love, preferably your growth companies, and like a Microsoft or a Google or an Amazon, you buy them, you hold them, and in 20 years you have more money. We all know the old guy that comes by our desk or whatever, bragging about, oh, I bought such and such a stock back in 1989. How is it doing now? And you're like, yeah, it's up 3,000%. Oh, well, I'm doing pretty good. And so we all know that that's the way we do this, but nevertheless, we can't help ourselves trying to get an angle and trying to beat this market. Or in this case, we're in a bear market, so try to lose the least amount of money. And that's what this video is about. It's going to be about how to use the VIX and triple leveraged ETFs to try and maximize our gains that we can through these tough times, and then also use the VIX to try and rebalance our portfolio to equities that are trading more favorably during these market conditions. So let me go ahead and share my screen and we'll get right into this. So here are some of the leveraged ETFs that I track right here. And there's a bunch of them here that like go long and short the VIX. But the ones we're going to look at here are the ones that go long and short the NASDAQ 100 composite index. And that would be SQQQ and TQQQ. This one shorts the NASDAQ, and this one goes long the NASDAQ. They're triple leveraged, so you see three times, and then you see 3 times here. And then the other ones would be like either short or long the volatility index. But these are the ones we're going to only concentrate on. These are lots of these. There are some that do this for like semiconductor and ETFs and so on and so forth. But we're going to be concentrated just on the ones that do the NASDAQ here today. So one thing that happened here on January 13th was that SQQQ did a reverse 1-for-5 split. And people that woke up on January 13th thought that they suddenly made a lot of money on SQQQ. I think if you went to bed that day, it was like $7 the night before. And the next day you woke up, it was $35 a share. And you're like, wow, I can't believe it. But that was just because it did a 1-for-5 reverse split. And on that same day, TQQQ, it split in half. So it went from like $100 and something down to like $70 something, something along those lines. So the SQQ and TQQQ ETFs, like I said, they were triple leveraged ETFs. The SQQQ and TQQQ act as leveraged ETFs that track the NASDAQ 100. The SQQQ ETF index looks to provide 3 times the inverse return before fees and expenses. In theory, if the NASDAQ falls 1%, then the SQQQ should rise 3%. Remember, you're shorting this index. This is one way to short the market. You're trying to benefit. When the market goes down, you want your portfolio to go up. So if you think that the NASDAQ is going to go down, you buy this index and it sends your portfolio up. And in theory, it is triple leverage, so you should set it up 3% for every 1% the NASDAQ goes down. On the other hand, there's the TQQQ. That also tracks the NASDAQ 100 and provides triple leverage. So 3 times the return before fees and expenses. So if the NASDAQ rises by 1%, the TQQQ should rise 3%. That's in theory, because it should be noted that these two ETFs are prone to time decay because they are made up of financial derivatives. Time decay being extrinsic value of a derivative. Time decay can be caused by factors such as transaction expenses. That is not one of the extrinsic value indicators. Managing costs, interest expense of debts, etc. So they're basically, you're paying a little bit for these things when you get them. And there's actually, even before you buy one of these, there's a little warning that says, hey, you're about to buy this. Are you sure you want to do that? And I'm going to show you why here in just a second. So if we look at the NASDAQ here, year to date, it has gone down 13.4%. It's gone down 13.4%. 4%. So we would expect TQQQ, which goes long the NASDAQ, to have gone about 40% down, right? Because if this goes down once, the other one should go down triple. Hopefully we're tracking that. So that one should go down 40%-ish. And if we look at it, year to date, it's gone down 39%. So this ETF is following the rules. It's going down triple because the NASDAQ went down single. So that means that the SQQQ should be up 40%. Well, let's see if that's true. It is not true. It's only up 29% because they took out their transaction expenses, managing costs, and interest expenses of debt. So this is why you have to sign that little thing that says, are you sure you want to do this? So when you lose, you do lose triple. But when you win, you only win double because of all these expenses. Now these ETFs underwent the split. In the case of the SQQQ, it did a reverse split on January 13th. If we look at January 13th here, the NASDAQ was sitting here on January 13th, and since then, it looks like it's down 7.4%. So we would expect that SQQ would be up about double that. So let's go back to January 13th, and SQQ is up 9.22%. So yeah, it's working like it should. It's up double, but when you because the NASDAQ went down 7%, this one is up 9%. But TQQQ, it should probably be down the full triple. Let's just see here. It's down 20, that's more than triple. The other one, the NASDAQ was down 7.4%, and this one's down 26%. And that's why, as it says here, you don't want to hold these things a very long amount of time. Therefore, investors should plan on not holding these leverage ETFs for long periods of time. There are people out there that say, well, let me go ahead and compare this here. Why wouldn't I just buy TQQQ just outright? Because it's triple leverage, and things are always going to go up, right? And if you look at it here over 5 years, the bottom line here is the QQQ, and the top blue line here is the TQQQ. So it's up a lot more than the triple Qs. So people are like, well, why don't I just buy that? Well, the reason that you don't just buy it is because, remember, when you lose triple. When you win, you only win double. And the reason why they did this reverse split on SQQQ was because the thing was headed to zero. So let's look at the max here of SQQQ. Back here in 2010, it was trading for what? What is this? $454,000 a share. What is that? Let me see if I can. $488,000 a share on February 12, 2010. And it got all the way down to now $33 or $40 a share. And you might say, well, that's because the NASDAQ is gone up in a straight line. So why wouldn't it go down in a straight line? But this is down 99.99%. It was headed to zero, which is why they had to do the reverse split. And you may ask yourself, wow, why would we ever want to buy these stocks? Well, there is a way that you can use this. I'm kind of coming up with a way that I'm going to actually use the TQQQs in a way that I can use this, and and the SQQQs. And I'm going to do this using the volatility index. I'm actually going to do it to try and rebalance my portfolio to kind of to evolve to our changing market and try and lose the least amount of money I can before this thing bounces back. And the volatility index is also sometimes known as the VIX. What the VIX actually measures is fear in the market. And it does so because it is derived from the prices of the S&P 500 index options. So call options, put options on the S&P 500 with near-term expiration dates. And from this, it generates a 30-day forward projection of volatility. And volatility, or how fast prices change, is often seen as a way to gauge market sentiment, and in particular, the degree of fear among market participants. So basically, the VIX is a fear gauge. And so, you know what they say, you know, Warren Buffett, his old thing, be fearful when others are greedy and greedy when others are fearful. Well, so I'm going to use this little anecdote from Warren Buffett and exploit it using triple leveraged ETFs. And I'm also going to use it to rebalance my portfolio. So when we look at the VIX here, we can see it's incredibly spiky. It spikes straight up, it comes straight down, and then it goes down, and then it goes back up. And so what I'm going to do is, I think that we can use these triple leverage ETFs, or at least I'm going to use it. I'm not telling anybody else to do this because this is risky. But I can see down here, you see the VIX level here is about 17, 16, 18. And then when it spikes, it goes up over 30. This one will go 30, 31. This one went up to 33. This one goes down to 36, and so on. So remember, be fearful when others are greedy. Be greedy when others are fearful. This is a fear index. So when it goes up high, that's maximum fear. When it goes down low, that's maximum comfort. I intend to sell and rebalance my portfolio when this dips below 18, and I intend to buy, if I have any money left, when this goes up near over 31. I don't intend to buy TQQQ, but I do intend to buy SQQQ when everybody's feeling good about themselves, at least in this market here. And the reason why I'm not going to buy TQQQ is because I don't feel like there's enough return to justify my risk. I mean, here it's great. If you'd bought TQQQ here at maximum fear, you'd have $42 then, and now it'd be sitting at $54. So that's about a 25% return, and that's not bad. And if you'd done it here, you would have started with $53, and if you'd have gone out at the very top here, you would have gotten a 20% return. But you're not always going to do that. It's because the way I'm actually planning on trading this is going to be with a trailing stop. And those of us not familiar with this sort of thing, so let's say that I sell something with a trailing stop. So let's say I'm selling AMD, and I want to sell everything. And what that means is that instead of using a market order, a limit, or a stop limit, I'm going to use a trailing stop on SQQQ, and I'm going to do it with 5% here. So 5%. And what that would do when we look here is that if, let's say for the sake of argument, SQQQ was 100, it would automatically sell at 95. But if SQQQ went up to 200, it would sell at 190. It's never going to sell until it backs up 5% from its all-time high. And that would actually work out pretty well for SQQQs here, because if you had at this point bought SQQQ when it dips below 18, like we said, where was the first place here? Right there. Let's say $28, it would automatically sell when it got down to about $25, we'll say $26. And let's see if it would ever sell here. It would not. It would just keep going and going and going and going. And then it would finally sell when it was 5% below $45. And so on and so forth. So you buy here and then you get out up here. And then again, when it goes below 18, I would not have bought it there, didn't get there. I would have bought, well, let me see if I'd have bought it here. Yeah, you could have bought it here and then just let it go up. So maybe 18 and a half, that's good enough. But my point is that I'm going to be buying when people are like super happy in the market. I'm going to buy SQQQ and I'm going to put a 5% trailing stop on it. In addition to that, I'm going to choose to rebalance my portfolio. And what am I going to rebalance it with? Well, one of the things that I've been really high on these days has been JEPI portfolio, the JEPI ETF, and that's a covered call portfolio. They trade covered calls on the S&P 500, and they also have a lot of very inflation-friendly securities within this portfolio, ones that are working right now. And so in the future, right now it currently pays 7.2%, but the forward yield apparently is going to be 9.08% distribution on this particular ETF. And if you had told me like 8 months ago, 9 months ago or so that I'd be really interested in an ETF that sells the S&P 500 short and is really heavily weighted in healthcare and consumer staples, I would have said that was something I was not interested in. And maybe a year from now, I won't be interested in it either. But right now, I like it. And so how is this thing weighted? Well, like I said, half of the holdings of this ETF are covered calls against the S&P 500, meaning it's going short the S&P 500. It's not short selling, but it is selling short. And if you look at the S&P 500 and the way it's weighted, this ETF is weighted a little bit differently, whereas the S&P 500 is weighted with 21.5% tech. This one's only 11, and this one's it's underweight financials, but it's overweight healthcare. It's underweight communication services, but it's overweight industrials and consumer defensive like Walmart and Kroger and things of that nature. So this market right now really likes consumer defensive and healthcare, and it's going to like it so long as inflation is high. It actually likes energy, but energy's run so much, I'm not so high on it at the moment, but it could run higher, I suppose. But the take-home message is it's short tech, which the street hates at the moment, and it's long consumer staples and healthcare. I myself, if you're one of these people, like I said at the beginning of this video, you're the old cadre that's like shaking the cane saying, hey, you should never sell, never sell, never sell. They're wrong about tech, all these, but they're right in the way that they trade. They trade with, they're looking to just process these things through, buy it and sell it next month and try and make a little bit of money. And in that case, they're right. But if you're talking about like 10, 20, 30 years down the line, and you're talking about Microsoft and Apple and Google and Amazon and things like that, well, you're not correct. Those stocks are clearly going to be worth more in 20 years than they are today, at least those companies. And so that's the way I'm going to go. I'm going to rebalance when the VIX goes below 18. If I have extra money, I'm going to buy when it goes above 31. I'm not going to buy TQQQs. I'm going to trade a 5% trailing stop on the SQQQs when it dips below. I'm thinking more like 19. If it gets below 19, I'll go ahead and trade SQQQs with a 5% trailing stop. All right, that's a wrap for this weekend's video. So yeah, if you got anything out of this video, please go ahead and like, subscribe, and hit that little notification bell. Until next time, we'll see you then. Bye.